Welcome friends to SensexKaFunda, your free channel on stock markets and the economy and a place to learn. This is a totally free channel. I do not promote any derivatives, any options trading, and I do not sell any courses. Now, in September, today we are going to learn about LTCM, the hedge fund that collapsed, and draw lessons from it for ordinary investors. In September 1998, the most powerful names on Wall Street were huddled inside a stuffy boardroom at the New York Federal Reserve, not to bail out a country, not to stabilize a currency, but to rescue a single hedge fund, long-term capital management. The irony, this fund was supposed to be bulletproof. It had two Nobel laureates, a host of PhDs, and some of the smartest minds in finance. But even these geniuses couldn't outsmart the markets. This isn't just a tale of hubris. It's a wake-up call for anyone who thinks that investing is just about being smart, because as LTCM proved, sometimes intelligence can be the biggest risk of all. Back in 1994, John Meriwether, a celebrated bond trader from Salomon Brothers, decided to build something extraordinary. He wasn't assembling just any investment team. He brought together a group of finance's biggest brains. We are talking PhD in physics, mathematics, and economics. Two of his partners, Robert Merton and Myron Scholes, were Nobel Prize winners. It felt like assembling Avengers of the Wall Street. But with this dream team in place, Meriwether hit the fundraising circuit, and the results were staggering. LTCM, his new hedge fund, raised $1.25 billion in a flash. European banks, Ivy League universities, and heavyweight CEOs lined up to invest. Why? Not because they understood the fund's strategy, but because the team behind it was dripping with intellectual firepower and prestige. But most of these investors didn't fully grasp how LTCM actually made money. But they also didn't feel the need to. They trusted the reputation, not the model. In their eyes, this was a bet on brilliance. Their model was built on quantitative arbitrage. These were complex strategies that exploited tiny mispricing inefficiencies in the global markets. It all looked flawless on paper, and for the first few years from 1991 to 1997, LTCM posted an annual return exceeding 40%. It attracted over $100 billion in borrowed capital and became Wall Street darling. But here's the catch. LTCM was just not smart, it was highly leveraged. And since the price gaps LTCM was exploiting were razor thin, to make any real money, they had to take huge bets. And that meant borrowing, a lot of borrowing. For every dollar of investment money, LTCM borrowed $30. Yes, for every $1 invested, it borrowed $30. And it had derivatives of 1 trillion. 1 trillion, ladies and gentlemen. Even though Warren Buffett warned us many times, derivatives are weapons of mass destruction. And all this worked perfectly until 1998, when the first misstep arrived. And what was the misstep? The trigger, a seemingly remote event. Russia defaulted on its sovereign debt. This was not something that LTCM's elegant models had modeled for. In fact, as markets panicked, the uncorrelated assets LTCM had bet on all moved in the same direction, down. Within weeks, the fund's capital shrank from $4.7 billion to under $500 million, and its web of derivative contracts, over 1 trillion in exposure, now threaten the entire global financial system. Now, the New York Fed had no chance but to call in the CEOs of all major banks. The New York Fed had no choice but to call in the CEOs of every major banks, Goldman Sachs, Morgan Stanley, JP Morgan, Merrill Lynch, and more, to coordinate a bailout. Eventually, 14 banks pooled in $3.6 billion to stop LTCM from collapsing. But the damage had been done. Genius had failed. At first glance, LTCM story feels like an institutional disaster, but its lessons apply to every investor, including investors who do SIPs in mutual fund. And here it what teaches us. Being smart is not enough. LTCM's team were academic titans. They were PhDs. But the markets aren't equations on a whiteboard. They are driven by human emotions, fear, greed, and chaos. Number two, leverage magnifies everything. Leverage can boost gains, but it amplifies risk even more. Many investors chase return with credit cards, EMIs, loans, or even futures and options. But that's a dangerous game. Just learn from LTCM. Even Warren Buffett, the Oracle of Omaha, said it's crazy to borrow money on securities. One should invest within one's means. Number three, black swans always exist. LTCM failed because it didn't prepare for unlikely extreme event, just like a black swan. Number four, arrogance is expensive. LTCM refused to disclose its strategies. It believed it was too smart to fail. Confidence is good, but when it becomes arrogance, it blinds you to risk. Number five, markets are humbling. If the smartest fund in the world can nearly crash the global system, so can overconfidence in your own investing. So if we are building wealth for the long term, here's the lesson. Don't chase clever sounding strategies that you do not understand. Don't rely on predictions. Stick to time-tested mutual funds. And number four, diversify your assets, equity, debt. Friends, this is all for today and hope you subscribe to my channel. Thanks. Bye.